In episode 1, the trigger was clean. First touch, both rules pass, no hesitation. This episode is the opposite scenario, and it's far more common. Price reaches the zone. The first candle that forms looks almost exactly like a valid trigger. If you were watching casually, you might already be reaching for the entry button. But this candle does not qualify. And the reason why is the entire lesson of this episode. This is episode 2, the trigger that almost wasn't.
Quick context. This is a GBP/USD 4H chart. Daily bias is bearish. Price is in premium. We have a 4H order block with an overlapping fair value gap inside the OTE band, and the minor sell-side liquidity sweep above this zone fired 3 candles ago. Same checklist as episode 1, 6 of 7 boxes ticked. The only thing missing is the 15-minute confirmation. Same starting point, different ending.
15-minute chart. Price is now inside the bearish order block zone. Remember, for a bearish setup, we're watching for a rejection from above, so we're looking for an upper wick and a small body near the bottom. The first few candles entering the zone are small bullish candles, buyers pushing up into the zone, but without much force. Then this candle starts to form, and right away, it looks promising. The candle closes. Let's check it. Rule 1. Wick at least twice the body. This wick is roughly 2.5 times the body. Pass. Rule 2. For a bearish setup, the body needs to close in the lower half of the candle's range. And this is where it falls apart. The body closed almost exactly at the 50% line, right on the boundary, arguably in the upper half. One rule passes cleanly. The other is, at best, a coin flip. This is not a confirmed trigger. This is the trigger that almost was. This is the decision point. The candle that almost qualified does not trigger an entry. Not probably fine, not close enough. The rule exists for a reason. A body closing at 50% means the rejection wasn't decisive. Buyers and sellers were roughly balanced by the close. We do not enter. The next candle forms, and it's small, indecisive, barely moving. Still no trigger. This is the part of the episode that tests patience. You marked the zone, you watched a promising candle fail, and now you're watching nothing. And then this candle. Price pushes up again, deeper into the zone this time, closer to the 50% mitigation level of the order block. The wick extends even further than the first attempt. And as the body forms, it's clearly lower this time, closing well into the bottom third of the candle's range. Let's check it. Wick to body ratio, comfortably over 3-to-1. Body close, clearly below the 50% line. No ambiguity. This is the trigger. One candle later than it looked like it should be. And that one candle is the entire difference between a confirmed setup and a guess. Entry on the close of this candle. Stop above the wick, buffer beyond the rejection high. Target at the next SSL level below, identified back on the 4H chart. This is a clean 3-to-1 setup, but it came one candle later than the first impression suggested. If you had entered on the first candle because it looked close enough, your stop would have been hit almost immediately, because that candle's high became this candle's wick extension. The patience between candle 1 and candle 2 is the entire trade. That's episode 2 of the drop-down series. The lesson here isn't a new pattern. It's the same 2 rules from episode 1, applied with the discipline to let a near miss pass without acting on it. Almost is not enough. In episode 3, we look at a different kind of delay. Price doesn't just hesitate at the zone. It pushes slightly past it first, sweeping a small pocket of liquidity before reversing back in. That's the sweep before the trigger, and it connects directly back to the inducement concept from earlier in the course. Subscribe for episode 3. Link to the full series playlist is in the description.